Hello, everyone. It's a pleasure to be here. It's my honor today to have a talk about investing in decentralization. I think it's a very, very broad and industry topic that today we're going to cover with three experts in the field. So I would like to welcome Mark from the previous panel, the CIO from Scytale Digital. We have Dieter from Dialectic and also Jens from Bitkraft. Very welcome. Big welcome from my side. And for initiating today's discussion, I would actually like to ask you, Mark, first, talking about VC, venture capital investments. How would you define the difference of venture capital investments in crypto compared to traditional markets? What are things that stand out that require a different perspective, focus to find the upside in certain deals?
Yeah, from my perspective, the key difference is that you get liquidity way sooner in the blockchain side, the crypto side, than is reasonable, especially against traditional, where you have to be with a company for a long time, and then you generally get liquidity through the IPO, which very few early stage companies get to that stage. However, the underlying reason for investing for us remains the same, but for many quote-unquote crypto VCs, they're not necessarily looking for what is going to generate value over the long term. They're looking for what they can exit quickly at a higher price.
Thank you very much. I think we opened two very famous topics in crypto. We have the benefit or the downside of very, very early liquidity. That can be beneficial, that can be counterintuitive. Nevertheless, it opens up a lot of opportunities, especially in DeFi, which probably is your key area as well, Dieter. So you're very specialized and active in the DeFi space. How do you look at VC investments, looking at unlocking early liquidity? How can you benefit from that? How can projects benefit in structuring the right path to becoming liquid or going to the secondary?
Yeah, so for us, like we call ourselves in some sense venture investors, but really we're early stage investors. We are kind of a DeFi specialist firm, so our thesis is that the greatest path to profitability is programmable money, and really kind of all the investments we make seek to capitalize this in some way. So generally for projects, we look at token upside generally, and for projects that are looking to basically like add liquidity or launch a token, they have to kind of take a Web3 native approach. One of the things we look for here primarily is like sustained on-chain revenues and the ability to build a community. But still, this all comes back to the value conversation that Mark was mentioning.
I think this is something a lot of us hear quite often, a Web3 native approach now. If we look at founding Bitkraft since 2015 in the space, you have close to 1 billion AUMs under management, different fund strategies. What's crucial for you investing in the gaming space? Is it a Web3 native approach?
Before I start going into that, let me just quickly ask a question to the audience, just to understand how sort of everyone is exposed to crypto to begin with. Would love to see who's invested directly into cryptocurrency, like in a retail style way. Raise your hands right now. Who's invested in structured financial products, like an ETF or something? Raise your hand right now. Okay, that's profoundly less. And who has chosen to invest into crypto through like a manager that he would back, which might be venture capital or like other like managers that manage crypto exposure for you in some different way? Well, equally, like a bit more than on the second one. Okay, that's interesting. So, as it relates to crypto in the gaming space, I think to quite a big extent we sort of have the same view than the group already shared, that we believe that the attraction of tokens as an asset class is one that gives us a different perspective and a different, like an additional reason to form a different strategy to expose ourselves to that. I think there's a bit of a romantic belief that it gives you quicker returns. I do think the essence is that you are exposed earlier into a liquid asset to begin with. contrary to the equity investments that we would typically do, where you're tied up and like maybe there's a secondary market for equity at a larger scale, but fundamentally you're tied to a company for the lifetime success of a company, right? And then with tokens as an asset class, you have something that likely is liquid to begin with. Now, in the crypto space, though, it can go both ways, right? If you're in a shit market, then like actually you can't sell anything for a long time as well. So you're like equally tied up in a bear market. In a bull market, yeah, you can dump your stuff quite early after like things go public, and that helps you obviously. But I think it's a bit romantic to say like it is a path to earlier liquidity. I think the like venture style approach to investing in the Web3 space in the last years has been challenged by a lack of liquidity. It has like kept people for longer in those positions. Now, besides like the appeal of a liquid asset that we then manage beyond just like equity that we typically also invest in with our crypto funds. We invest in equity with token exposure on top through SAFTs, mostly. I think the additional attraction then is a technology attraction of what does the technology bring to the table in creating greater games experiences, right? So it's like both of these things that make us to invest thematically in the gaming space with like blockchain and crypto being a core part to that.
So we touched a lot of different concepts. I would like to follow up with one specific one. Looking at markets, if markets are bad, liquidity is low, investors are held to being longer in the asset. We've seen some people in the room are invested in a fund manager-based structure, which in the end is a structure that has to generate returns for the LPs, the limited partners in the fund. If you had to choose, and can start with you first, Jens, if you had to choose very objectively between two approaches from a fund manager's perspective, where do you think the odds are higher, as you mentioned in the VC perspective, of the ones taking the chance to have unlocking the liquidity very, very early, or the ones that are doing the due diligence for the high quality deals where they're betting more similar to a private equity investor over an at least 3 to 5 year horizon?
I think the answer would not be one that is exactly too tied to the points that you have there. I think in the first place, and first and foremost, we want to invest in entrepreneurs that have the right mindset and long-term view of what are they building that fundamentally unlocks a lot of value to begin with. That in the first place is the deciding factor of what wins. Now, unfortunately, in the crypto space, I think there's been a history that has educated people that like a loosely regulated space like allows you to do things with tokens that you would probably not get away with if you would be in a properly regulated and structured space, and formal agreements on governments would be in place at all times. So sort of since we have burned ourselves, and I think many people have burned themselves in just investing in sort of like some pure token setup DAO style, we prefer to have additional security rails in place by investing in the equity. That is additionally our job because we manage like people's money here, right? That's not my own money. Like if I go into the casino, that's my own decision. I should not go into the casino with like third-party capital. I have a fiduciary duty to make sure that investors are protected. So beyond my belief that we invest fundamentally in entrepreneurs that have the right mindset, that will like not go off the rails, that will not take liberty of interpreting an unregulated space in very creative ways, potentially to the disadvantage of their investors here or there. We like to be at a place where we have governance in place that is granted to us in the first place in equity structures. And then gain additional upside with token exposure as the company launches a token smartly and at the right point in time, which sometimes may mean I'm only launching in 3 years, not in 1 year. That's part of the game, right? And we can wait for that long. And we will not be the investors that will force the team to launch their token at an unopportune time or with the wrong product configuration, because we know it's eventually delivering a worse outcome. So we like those setups. We're also mindful, though, that value accrual, all of a sudden, if you invest in that hybrid structure, is on both sides. And there's an art of how to balance the interests of the token holders that are not equal to the equity holders, like in the right way so that no conflicts appear and you have long-term upside on both sides, right? And that's, I don't think we have found the perfect recipe yet, but it's an art to get that done well. Yeah, sure.
Could I just make one observation, which I think is quite interesting? So, you know, we, like both Mark and I have, like our firm has primarily invested in the crypto space and then specifically in DeFi. And I think, Jens, your firm is gaming, and then you went into crypto at one point. And then Mark, you're all in on crypto, right? And we'll do some liquid kind of.
But we do equity as well.
But equity as well. Yeah, so I'd love to hear from you. Like, how do you fundamentally, right? Where do you think like tokens help gaming companies? And like, what's the story of Bitkraft? I don't know what the evolution was, but was there some point when you're like, let's evolve from just a gaming VC and, look at this token upside? And I'd love to hear, how that happened, where that went, how you guys think about that.
Again, in the game, I mean, some of you might have been here for the gaming panel already, so I hope I can be additive to what we shared there. But we look at two aspects of what crypto and blockchain bring to the table for games. One is a shared aspect with, I guess, DeFi as well, where you might have a token that might play a central role in the game as a virtual currency in the game as well. And that token is a reflection to some extent of the performance of the game in the sense of like, is there a functional economy, and thereby value can accrue to that token. That doesn't make sense in all games. Who here knows Candy Crush Saga? I'm sure a lot. What? I thought a lot, right? So Candy Crush Saga is probably the most popular like casual game on your mobile phone. How many people play mobile games? Okay, so anyway, it's a very casual game. In a casual game like Candy Crush Saga, a token doesn't make sense at all. Right? It doesn't have. There's no way you can come up with a way of like there's any utility that makes sense. So there's certain game genres where it doesn't make sense. Then there's game genres that already have virtual currencies, that have complex economies. We're leaning more towards what we call MMORPGs, games such as World of Warcraft, EVE Online, and whatnot. There, a token can make a lot of sense because it replaces something that's already there with an added elegance because of the technology and an added opportunity for value accrual. So that's the one part, right? The other part is, again, the technology brings new capabilities to like item ownership and thereby like value for gamers on top. But that's lesser of the discussion that we have here. But our view matured that these games that use a token as a primary or secondary currency as part of gameplay will figure out the right way on how to balance the economy so that there's value accrual to the token as well as an increased game experience and fun with the game. And when we, like the time when we made, I think for us, the switch happened was about 2020, 2021, when we felt like all these very, I want to say crypto first and maybe a game second, but still saying like we're a crypto game, like crowd fell out, like started to disappear, and a profoundly new generation of entrepreneurs like really built profound experiences.
I think there were a lot of interesting points raised. I would like to go one back. You mentioned a couple of very interesting points, like the quality of the founder, the drive of the entrepreneur, the team, the governance, the corporate structure of how the entity and the legal contracts are set up, the patience, investment horizon. What are additional things that you're focusing on, Mark, in picking the future winners in your portfolio to have the highest quality possible in the deals? What are additional things where you see you can bring synergies to your investments, or things where you see it's very crucial to differentiate and watch on these additional? So
those criteria are enough, right? So it doesn't have to be additional. If you could actually do that, that's really enough to have a very successful portfolio. However, what we find through our experience, and I can use a concrete example of mythical games. So they were on stage before. They are a game studio and a platform. And where I get more confidence of the efficacy of it is when a game founder like Roman over here says, well, we were looking at different blockchain, but it didn't make sense, all the other stuff out there. And then I met John from Mythical Games, and I said, that's it. This makes my business better. And anything that makes a business better makes a business more competitive, more profitable in a very competitive environment, is something that will increase the chance of success. Because it's all a probability game in the end anyway. And you could be with the best founder, with the best business model, and shit market conditions, and it runs out of money and doesn't work. Or the time isn't right, there isn't the critical mass around. And I can use the example of a company called Share Your World, which was out in 1997, was almost the identical model of a company that was launched, I think, in 2004, which was YouTube, which was wildly successful. Same business model, but it had the environment around, the critical mass around where it could be successful. And I think we're going to see that now, especially with gaming and blockchain. And I think Mythical Games is going to be the lighthouse, the beacon of that success, where here are games that are better because they have blockchain component somewhere behind the scenes, and a platform that will be very much of a competitive advantage for those that are part of it. And so that's a sort of synergy, which you mentioned. So I think that, so I'm really excited about that. It's on the path. It's not there yet, but I think we're going to see the proof once the big name is launched in July or so.
That one we're all very, very curious to see, very exciting. One thing that I'm very curious about that I would love to have answers from all three, if you look at deals, it's very similar as in traditional finance. As Mark mentioned, it's all, in the end, you can do everything right, but there's still a probability of things going well and things not going well. What would be your optimal portfolio size of amount of deals that you would like to hold in a theoretical concept? Do you see a difference in crypto to private equity? What would be your preferred amount of different deals that you would like to hold in a fund?
So for us, like what we actually figured out, I think, kind of when we were raising our halfway through our first fund, is we're pretty good at basically calling, say, having kind of a 25% hit rate on deals, where, about a quarter of the investments we make will get between, say, 5, 10x plus in terms of returns. What we actually found out is we're very bad at sizing. And I actually think this is like not unique to us as managers. Like, I'd love to hear if you guys found the same thing. So for us, really kind of what works best is now, like in our second fund, we have 3 levels of deals based on conviction. So like we have kind of exposure, thesis, and conviction bets. Our kind of ideal size is somewhere between 20 and 60 names, but we need a minimum level of diversification to actually do well. I think ideally, right, like if you could predict the future, you would choose one name because nobody ever got wealthy through diversification alone. But
diversification of profits as well, right? I would just add that there's no special number that you need to have a good portfolio. I think diversification is important, but I really think it's also a matter of the resources that you have. So if it's just a spray and pray kind of thing with 100 names with 3 analysts on the team, you're not going to do a very good job of being on top of them, but if you have decent criteria, you probably should perform in line with the market. I would say our approach is different. We have fewer investments versus the number of people we have on a team because we want to be as involved, to really behave like partners of the teams we invest with.
How is it in your case, Jens? If we look at more from a thematic investment front that is covering the gaming sector, is there something that crosses your mind, an amount of deals that you would like to have or that you would like to have as a minimum, or similar to Mark, of course, kept given resources as a maximum?
So to begin with, I think the answer is not specific to Web3 or crypto. And I think that's an important point to make, right? Like if you deploy venture style, early stage in the Web3 space, then the math and probabilities that apply are not different from investing in, I don't know, general tech, e-commerce, or biotech. It's like statistically, you likely have like good outcomes with like 20 plus portfolio companies, I'd say. Same applies here, no difference. Now, how can you make 20 portfolio companies work is a function of also, can you pay your staff and yourself? So likely you're going to be more challenged if you have a 5 to 10 million funds, because like the fees that you have to pay people that are pretty fucking good at their job to like make that happen is difficult, right? That's the challenge of emerging managers that start with like a limited pool of capital to begin with. Then though, not really on topic, but like emerging managers have a secret sauce that mostly they start with a private network and don't need that many additional resources, and that leads to statistically emerging managers with small funds to actually outperform, but that's a different story. I'd say 20 portfolio companies about is the size where, like, you know, the math is, and I'm sure most of the room knows that, but the math is like, of 20, you have 1 or 2 that will like absolutely outperform. That needs to be the math, and they're the fund returners, right? They create the real upside. Then you might have like 5 to 10 that do okay and give you like the 3, 4, 5x return, or maybe a 10x return, and then there's like 10 that are write-offs. Like you just don't get anything out of this, maybe an equity higher. So I'd say that's probably the number that works, and there's no difference in crypto, particularly early stage, because again, you're investing in teams that mostly have no product market fit yet, have an idea about a product, maybe a prototype, maybe bootstrapped or initial small angel funding, but like there's no proof yet that you have something scalable at your hand. And so the probability that you totally fail still is still very, very high. That will be different if you talk about a late stage strategy. That could also be venture investing. And a late stage strategy, you might make that strategy work with just 5 investments, right? Because you pick maybe like you go in the secondary markets even and just don't even try to lead deals. You could deploy like 40, 50, 60 million and concentrate that on 3 or 4 or 5 deals with high conviction. And you could drive a decent return over 4, 5, 6 years, right? With like good IRR of like what, 20% if you're good. And that might be a smaller portfolio. Early stage, that's impossible. Like that's hard, very, very hard.
Very, very interesting part. So to summarize, I think everyone who wants to not only invest in decentralization, but wants to open up a fund, I think we heard the guidelines, 20 plus deals, minimum 10 million. Do the due diligence on the fund manager, diversify. And now we're getting to one of the Web3 topics. We had some topics about gaming. A token can bring a added value to the enterprise. So what are markets that are being unlocked that were not possible to be unlocked? Or what is the real added value in the end on a P&L basis by using the token in gaming compared to not having a token element in a traditional game, for example? If you want to start, Mark.
Sure. Well, I just will stick with the example I was using before of Mythical. So they have empirical evidence that having the sense of ownership in a game will keep a player in a game longer. And there's a high correlation with the amount of time spent in the game and the amount of money spent in the game. And so the marginal production cost for the game to have people play longer is very close to 0. So the longer people will stay in and the more money they spend, the better that is. And that's what in my opinion, is a big product driver. So it's not directly on the token, like the concept of play to earn, which Jens said earlier, just doesn't make any sense, never made sense. People made money at it for a while, so then it all of a sudden was a new way of investing, which ultimately it wasn't. This is something that does make sense, right? If there's a way for people to feel more engaged to something, more loyal to something, and be actually happy to spend money in the game because they're getting a better experience. Because at the end of the day, this is entertainment, and people don't get paid to be entertained. Entertainment is something that costs, and it has to be worth it. Now, maybe it doesn't cost directly money. Maybe it costs attention, which is also very valuable and monetizable. But at the end, it has to be something monetizable. But it doesn't only apply to gaming. Like there's a lot of other blockchain use cases which are revenue generative. DeFi is one of them. Like borrowing and lending is something that's been done for a long time. And if it's something that can be done on-chain in a better way, that's more effective, then that will increase the profits for the borrowers and the lenders, and the platform costs are very low compared to the traditional ones. Or we'll hear from Ed later, who's sitting in the front row over here. Please be here for his talk, but he's going to talk about revenue generation in the energy space, which is energy is everywhere, right? And if it can be improved by using blockchain, the energy markets, and it will happen. And people that are participating in it will have a chance to benefit from that.
Strongly agree. And I think I would like to use that one to go a little bit into on-chain revenues in the DeFi space. How do you filter or select deal flow, focusing specifically as on-chain revenue driver in your selection process?
Yeah, I mean, for us specifically, right? Like, again, you first want to see if a business actually makes sense, and then, you know, why fundamentally DeFi? I mean, first of all, like, if you actually believe crypto is going somewhere, right? If there's going to be some applications which attract users, there needs to be some sort of financial underpinning, right? Like, as the world has evolved and it has like the notion of corporations and companies have got more complex, like, our kind of traditional finance system have kept up with that. And you have things like, you know, investment banks helping companies to hedge and things like this. And the same is true for crypto. So this is why you fundamentally need DeFi. This is why we actually bet on DeFi in a lot of big ways, because in a sense, it's like levered beta to the whole space. And so what you want to see in kind of these business models is you want to see a reason for having this financialization. Like, does it serve either like a current or future use case? And does revenue really, usually this is going to be in terms of like fees paid to a marketplace for certain services, you know, such as like exchanges or lending protocols. Is this returned to token holders in some way that makes sense, right? Is there protocol revenues that are paid as fees for these services that are given back to the token holders of the protocol, usually at a buyback and burn method. That's generally what we look for, and when we try to think, you know, if the space grows, does this market grow as well? It's quite simple.
I would have a follow-up question to DeFi yields in general, out of personal curiosity. Don't you have to assess as well if these yields are sustainable? If you look, for example, at typical yield farming, automated market making, I'm exaggerating, but you are the market. You're basically placing the ask and the bid. You monetize the spread, exaggerating in simplification, but isn't that market becoming tighter and tighter over the years? So also the yield is decreasing, or do you expect them?
Yeah, I mean, this depends what you're doing, right? So if you're investing in a, say, for example, like a decentralized exchange, and you're taking a bet on the business, right? Then you want to make some fundamental estimate of realistic long-term fees, which is probably not in line with what these current fees are today. It probably gets lower, to your point. But if you're a liquid investor, and I mean, like, we do DeFi investing, we do a lot of early stage investing, or like somewhat, but we also do a lot of liquid investing where we actually, you know, supply liquidity on chain to harvest these yields. Then you don't actually need to have an opinion there. You can just be mercenary for the yields as long as your strategy is liquid enough.
Now, for you, Jens, we saw the token element being directly correlated to a higher profit margin in the end for the gaming business. So we can increase the time per player, or we can enable with gamification a higher activity per player. Do you see additional benefits with token elements of projects that you see in the gaming vertical?
I think we're overall, and that's what everybody I think has to recognize, we're very early in understanding what the best use case ultimately could be, what many different best use cases will be. I will not be claiming or would try to explain to anybody that the price of a token for our industry and maybe in other like sectors as well somehow is like a sophisticated calculation of earnings or like returns that are made on the protocol or on the token. Like, that's nonsense. Like, the value of a token and thereby like the perceived success of a project as of today is mostly narrative. It's mostly excitement. It's mostly a belief in something that does certain something in the future. And that somehow feels a bit tricky for somebody who would invest in things that are like a bit more predictable, a bit more, I'd say, like grounded on financial metrics. But in a world where I believe even in the public markets, narratives start to play a much larger role. Stock prices on a range of stocks decouple from fundamentals increasingly, driven in particular by a younger retail investment audience that, by the way, more likely than not is crypto native. So we are investing in a space where we can talk a lot about what accrues to the protocol potentially in the future. I will not go in all the details of what that could be. It certainly would expand the panel like enormously, but I think it's important to understand for people, A, there is no correlation of a token price to what real utility or what real revenue is produced on that piece to begin with, right? Second, it's a very narrative-driven market on top of it being a market that's driven by like general liquidity like globally in the money markets. And when you put that together, the art of investing in an early stage startup that launches a token that hopefully delivers additional like value in various different ways to the game is certainly that you have to time the market right. You have to make sure the narrative sits right in the right markets at the right place. Example is we actually dabbled in like AI gaming tokens just at the right point in time, right? The AI like narrative is still strong, but like that was like a profound way where you saw like that was timing, that was market, that was narrative. The same applies to gaming, which as of today, as of now, gaming tokens do poorly because like there's no narrative behind it, there's no excitement behind it, so we're working off a difficult place today. I'm deeply sure it changes in the next 6 to 12 months with like great product to come into market. But again, we're still so early of really understanding how will this play out. It's just something that everybody has to be aware of. And I'm not going to be like an institutional investor under the SEC that like takes like LP's money and claim like that we can predict the token outcomes in the market that there is today. We cannot, right? We can take the best learnings from how markets behave, what narratives are, what founders look like, what technological progress looks like, what game design looks like, and do our best to predict what happens with that token. So far, that's been doing well. But it's more than just a spreadsheet, way more than just a spreadsheet.
I think that's a very, very essential part. Goes back to the diversification aspect as well. Now you made the point of zoom out. You do have to navigate the uncertainty. You need to time the market, which is the most difficult thing ever. And you need to have the right narrative that is upcoming in the future. So going to one of the probably most interesting questions, and I would love to hear all three of your opinions. How do you see the markets behaving over the next 6 to 12 months in terms of primary markets relative to secondary markets? There were some points mentioned of global liquidity by Jens. Maybe it could also be when do you expect the QE potentially to start? Or how do you see that effect playing into primary market investment thesis? Dieter, you can have the pleasure.
Yeah. So, you know, I'm famously bad at macro calls. However, like, you know, you've seen like glut of capital raised by kind of early stage crypto funds, not really recently, but say in the lead up from like 2019 to 2020. Recently, this has fallen off a cliff. You know, I think it's something like, I was looking at a chart recently and it's something like, must be 50 to 100 billion or north of that raised kind of in 2019 to 2020. And then in the last year, it's been something like $500 million, like, you know, orders of magnitude lower. You know, this opens up to some degree an opportunity set, considering there's a lot of like really good quality entrepreneurs there building projects, less capital going into them. I think this combined with like a lot of structural changes in the US with regulation, I mean, despite the Trump presidency, let's start talking about this now, being, you know, very different in a lot of ways, you can't doubt that a lot of the changes on the regulatory side are attracting like better and better entrepreneurs. So, you know, I think it's probably a good time for deployment into early stage at this point.
So I don't run our crypto strategy, right? So I am not in the day-to-day of what the team sort of sees for the next 6 months. What I look at and what informs me right now is mostly regulation. That gives me the strongest confidence in something pretty impactful and profound happening in the next 12 to 24 months for our markets and gives me a lot of confidence in what we're doing in the crypto markets. It's regulation and it's me also spending time with, I don't know, the Goldmans and the BlackRocks of this planet and seeing what are like the big like institutionals like doing and how are they behaving in these markets and what are they seeing in inflows and positioning from their clients in these markets. When I add all these data points, then my optimism for the next 12 to 24 months for our portfolio at least, like I have a quite high conviction that something good is can come out of that. But the prediction for the next 6 months and where, I don't know, interest rates are going and what that means for primary or secondary markets, that's like a tactical decision that sits with the investment team and my liquid team at Bitkraft, and I wouldn't be able to comment on today.
And I would just add, like from our perspective, we're fundamental investors. Each position has its own idiosyncrasies, and that's what's going to drive our returns. And of course, the market conditions absolutely matter, especially on the token side, on the equity side as well, but especially on the token side, because sometimes when the market is frothy, all valuations get frothy, and that's a better time to generate liquidity for the portfolio. Now, I don't have a strong view over the next 6, 12, 18 months. Is it going to be better? Is it going to be worse? There's a lot of factors for both sides, and one of the things that increases liquidity or worse conditions, and then what does that mean for the price? And so that's also very hard to predict. But what we can work with are the teams that we've invested with and what stage they're at, and help them to have the best possible result for their businesses.
A very aligning point from all of us is the regulatory landscape, especially driven from the US, also in crypto. Most of you aligned to state that it's going in an overall very positive direction. How do you see that impacting venture investments specifically in the Web3 space? Do you see something that is a specific sector or segment that benefits more than others due to the US regulatory changes that is being impacted in Web3 verticals?
I mean, I think this just, like, you get the potential for a lot of small, big changes, right? So you get, the potential for companies like Apple to have, to take the risk of actually featuring crypto in their products, right? So I think this is where the biggest changes can be made. But is there like a specific vertical that if this affects? I mean, probably not. Like DeFi is really the only vertical with product market fit to some extent. I mean, gaming had its moment and I think it could come back, but we haven't seen like kind of that be as durable. So I think this affects DeFi first, and what comes after that, we shall see.
Oh, we're wrapping it up. We're out of time. So in that regard, a big, big thank you to all the panelists. Today we got a big overview, top-down and bottom-up. So if anyone is inclined to know how to set up the best performing fund, these are your experts here to tell you all the secrets. I think we got a very interesting overview, how we navigate the uncertainties in a very, very still new sector of driving Web3, looking at governance, processes in investments to invest in projects that have a token and an equity component, and how it provides an additional value in the gaming sectors. If any one of you has, if we can wrap it up with a final sentence on an outlook of Web3 at all, and then we would close it down. Mark, if you want to have a final.
I would just say this industry is inevitable, right? It's happening. It does make things better. And we will see, as time goes on, evidence of that.
I mean, the only thing I would say is that, we haven't really talked about, why crypto fundamentally. I think, what's really interesting about crypto is that it enables, a lot kind of lower trust cooperative structures, right? Similar to the corporation being invented in, the 1800s, which allowed, limitations of liability and pooling of resources. This is what crypto should enable fundamentally. We're still very early. We haven't seen what this actually means. And I think there's going to be, different sectors in vogue in a much bigger way, much more evolution before we actually see really what the power of this is. And surely it's not just DeFi, because that would make literally no sense. So there's a greater power here that's, still at work.
I don't know, maybe a stupid combo. I feel like if you're investing in the space, for me, it feels a lot like it's still a bit of a casino here and there, and it feels like the best way to go about touching the space is just to, if you like invest in like projects and not just like in majors and potentially in structured projects and majors, is like you gotta find somebody that like understands the casino, but he doesn't have the casino player addiction themselves, but understands like what addiction means here, right? I feel like looking at many other funds in the space over the last 5 years that we have seen on our cap tables, that we partially sat on boards with, it was quite interesting, I would say, to see the level of professionalism that came forward from some people that have, like, as part of the rise of crypto, formed their first funds and went out and allocated money in ways where I was like, okay, guys, like you're clearly part of the problem, right? And not part of like the solution. And being part of the problem sometimes in these cases could still mean there might have been insane returns, but I would rather stick with the people that can generate returns, yet have a clear, sober eye and like a strong sense of like, I want to say, how to manage other people's money and be good stewards of that.
I think that's a beautiful closure also in terms of governance and investment processes. Thank you all very, very much. It was a pleasure. Feel free to ask questions directly.